Hello students, this is Sonette Smith and this is lecture 2 on statement of cash flows. So I'm going to be doing question 11.1 and question 11.4, the cash flows from operating activities section. So in question 11.1, we are given information for Kumba suppliers for the year ended. Remember, cash flow statement is for a year and the year end date is 30th of June 2002. So it's very important to notice this is the year we're busy with, 30th of June 2002. So these will be our closing balances, and 30th of June 2001 are the closing balances at the end of last year, the opening balances beginning of this year. So those are the balances at the 1st of July 2001, which is the beginning of our current year. So at the 30th of June 2002, they give us the closing balances for inventory, debtors and creditors. These are the opening balances. And then they also tell us what are the total purchases and the total sales are for the 30th of June 2002 year. What's important to remember is because there are debtors and creditors, it means that the sales and purchases number do not necessarily represent the amount we actually received from customers and the amount we paid to suppliers. So we're going to calculate the total amount of cash that Kumba suppliers actually received from their clients for the year ended 30th of June 2002, as well as the amount of cash that they paid to their suppliers. Just for their inventories, we're not going to look at other expenses in this question. We are going to assume in part A that all purchases and sales are done on credit, and they tell us here to use a debtors and creditors control account to do our calculation. So remember what we've said is that these two amounts for purchases and for sales include amounts we've bought on credit and amounts we've sold on credit. So it means that we don't know yet how much we actually received from customers for sales and how much we actually paid to suppliers for purchases, because the amounts we received and paid will not be the amounts the same as the amounts we earned for sales and the amounts we accrued or the actual expenses or the purchases for the period, including the purchases on credit. So we are now going to be reconstructing the debtors and creditors control accounts so that we can work out what the cash amounts were. So we're going to reconstruct our debtors and creditors accounts here using the balances they give us. So the opening balance that's going to be brought down here, according to the question, is 14,500. And the closing balance that we are going to carry down at the end of the year is 16,800. So that will be the balance brought down for debtors at the beginning of the next year. Okay, so that information is given in the question. And then for creditors, the creditors has a balance on the credit side. So the balance brought down, the opening balance is 23,000. We're given that information in the question. And the closing balance that we're going to carry down is going to be 19,200. We're also given that in the question, so that will be the opening balance at the beginning of the following year, owing to creditors. Okay, so now the other information they give us is they tell us how much is purchases and how much is sales. So remember, for sales, when we sell on credit to customers, we debit debtors and we're going to credit sales. And the amount they've given us, we're saying that all the sales are on credit is 457,740. So the debtors account is debited and the sales account will be credited. Then on the credit side of the debtors account, we will then show the payments that we receive from the debtors for sales. So what we can do is if we add up these two debit amounts, the opening balance plus the sales, credit sales for the year, and we carry that across to the other side, and then we subtract the closing balance, that's going to give us sales for the year of, receipts from debtors for the year for sales of 455,440. So that amount is going to be the amount of money we actually received. Here was the amount that went on to the SPL, because that includes amounts that haven't been paid for. This is going to go into the statement of cash flows, because that's the actual cash we received from customers. So in the creditors account, what we're going to do is put in the amount that we that we purchased on credit from creditors. The inventory purchases, they tell us, are 261,300. So if we're using a perpetual system, we'll debit creditors and debit inventory with 261,300. So if we add the opening balance plus the amount for inventory, we get 284,300 as the total, which we take across to the other side. And that then leaves us with the amount that we actually paid to the creditors, which will be the balancing amount, where we'll credit bank and debit creditors with 265,100. So this amount is going to go into your statement of cash flows as payments to suppliers, and this amount will be your actual purchases that's going to go into your statement of profit and loss, part of cost of sales. So in this question, the first part of it, we had to calculate the 455,440. That was the amount that was received from customers, and the 265,100, that was the amount paid to suppliers. Okay, so now if we carry on with part B of the question, what's different here is that they are now going to separate purchases and sales into cash and credit. You will notice the amount for purchases is still the same and the amount for sales is still the same, but instead of everything being on credit, some of it is going to be for cash and some of it is going to be on credit. So they've split the amount here for purchases and for sales between cash and credit amounts. So we are going to reconstruct how much was received from clients for the year, as well as the amount that they were paid to the suppliers for the year. But we are going to include a sales and inventory account, because now not everything is on debit and not everything is on credit for debtors and creditors. So in other words, debtors is only for credit sales and creditors is only for credit purchases. So now the first step is always to put in our opening balances into our various accounts. So in the inventory account, the balance brought down from the question, they give us 28,500. Remember, this is an asset, that's why it's got a debit balance. And the balance carried down at the end of the year, they give us is 19,200. And that's the balance then that we'll start with the beginning of the next year. That'll be the balance brought down, 19,200. And then the debtors balances they give us as well. So the debtors balance, this is also an asset, so we'll debit debtors. Balance brought down is 14,500. That's your opening balance. And then we will carry down the closing balance, which is 16,800. And we'll carry that down here to the debit side, which will be the opening balance at the beginning of next year. And then creditors, we will put the balance on the credit side. Balance brought down, that's your opening balance, 23,000. And then the closing balance we will carry down at the end of the year is 19,200. Okay, so here we will have the balance at the beginning of next year that will start with owing creditors 19,200. So now let's look at the purchases amount that they've given us. They tell us that 42,800 of purchases was paid for in cash. So what normally happens with that is, if we are using a perpetual system, when we buy inventory, we debit the inventory account and we'll credit bank with the 42,800. For the creditors, the amount that we've purchased on credit, we are going to credit the creditors account with the credit purchases of 218,500, and we are going to debit the inventory account with 218,500, and that's the amount that we've purchased on credit from creditors. So we can actually see now in the creditors account, if we add up the credit side, the opening balance that we owe to creditors, plus the amount we've now purchased from them on credit, it gives us 241,500. And if we then subtract the closing balance, that's the amount we haven't paid the creditors yet. It means we actually made payments to the creditors of 222,300, 222,300. What we're going to have to do is we're going to have to add this payment together with that payment to give the total amount of payments to suppliers, which will be 265,100. So that's adding the payments for inventory that were paid for cash together with the payments to creditors where we bought purchases on credit. Then if we go and fill in on the sales amounts, we are going to first of all show cash sales, where we are going to credit the bank account, credit the sales account and debit bank with 260,000, because that is the amount of cash sales. And then the amount of sales on credit, we are going to debit the debtors account and credit the sales account, because now the debtors owe us another 197,740. And here we're going to write debtors in the sales account, 197,740. So that means we can now see that our debtors owed us 14.5, plus we've now sold to them on credit 197,740. So that gives me a total of 212,240, which they owe. At the end of the year, there's 16,800 that they haven't paid, which means the balancing number here, which they actually have paid, that we're going to show on our statement of cash flows, is 195,440. And that 195,440 is what we've received from customers, plus this 260,000 here. The two together are going to give me 455,440, which is the total amount that I've received from customers. You will see if you go back to question 1, this ties up, part A, this ties up exactly to the amounts that they gave us in part A. So it doesn't actually matter whether amounts are on cash or credit. You could actually just put everything to the debtors and creditors control account as we did in part A, and you'll come up with the same answer. And that's also the way that I showed you in the lecture when we did the example 11.1 from the lecture 1. Just to finish off, we're now going to just close the inventory account as well. There is a mistake in your solution. I just want you to take note of it. The cost of sales amount is supposed to be 270,600. In the solution, it shows as 320,600. Please fix that. The way you get that is you take your opening inventory, which is 28,500, plus the amount purchased during the year. It's all going to be the balancing amount, plus the amount we purchased on credit. That's going to give you 289,800, which you're going to take across to this side, 289,800, and you're going to subtract the closing inventory, which will then give you the cost of sales amount. So we've now finished all of the accounts. The only other one I want to total is the sales amount, because that's the actual sales for the year, cash and credit sales. And this is the actual cost of sales for the year that we've calculated over here. Those amounts are going to go onto the SPL, but the amounts that are going to go onto the statement of cash flows are these two amounts here. This is the payments to suppliers for purchases, and these are the amounts we've received from customers for sales. And that's the end of question 11.1b. So as I said, just please make this change here in the solution in your book. That should be 270,600. So you can just change that. Okay, so now I'm also going to be looking at question 11.4. If you look in your textbook on page 299, there is a format for you to do part of the question with me. I do suggest you keep the question open and you can work through the format if you want, but I'm going to use that format in helping to answer the question. Please take note, this is for a CC. We're not teaching you CCs. It's very easy in this question to just think about it rather as a Pty Limited or as a Ltd company. There are one or two small things that we'll just have to rename, but the fact that it's a CC doesn't mean we can't do the question. It's still a cash flow question that we can use in order to explain cash flows. So please don't let it put you off. So we've got ACC Tech Pty Limited and Allen and Tamby are both members. That means they are owners. They are shareholders of the company. And we are given information for the year ended 28th of February 2008. Here's 2008, and this is the prior year 2007. You will see when we reconstructed the ledger accounts how important it was that you knew which was the opening balance and which was the closing balance. We are going to be dealing with only the cash flows from operating activities. So we're going to be looking at current assets, inventories, trade debtors, and allowance for credit losses because that gets deducted from inventories. And we look at trade creditors and current tax because those are current liabilities. The bank account I'm not going to look at now because we do finish question 11.4 once I've done the other sections of the cash flow statement. And I'll show you how everything balances to the amounts in the bank account. What I first want to say is if you think about the allowance for credit losses, this allowance for credit losses changed by 200 Rand. But that change, there's no cash effect to it. All that we've done is we've decreased the allowance for credit losses. So that decrease in the allowance for credit losses will be a debit to allowance for credit losses, credit the statement of profit and loss, with the decrease in allowance for credit losses. There won't be any cash effect. So this is non-cash, the change in the allowance for credit losses. But inventory and debtors and creditors and current tax, there will be bank account entries in each of those four accounts that we're going to have to reconstruct to see what those amounts are. We're also given information that don't give us the statement of profit or loss. I suggest that you reconstruct it, and we'll do that later on. This is information for the year ended February 2008. The profit for the year is 115,000, and that's before tax. The tax expense for the year is 31,000. Okay, so that's the tax expense on our profit. 68,000 of the profit for the year was distributed to the members. I want you to call this a dividend. Okay, so we're going to think of that 68,000 as being a dividend to the shareholders. So it's going to be distributed to the shareholders as a dividend. And then the following items were included in the profit before tax. Interest expense we have to show separately on the statement of cash flows. Depreciation is a non-cash item. The profit on sale of equipment, if you remember the profit on sale of equipment account, the profit is not a cash amount. It's the amount you receive for selling the item that's a cash amount. But we're not going to do that now. We'll do it when we do section 2 of the cash flow statement, where we look at cash flows from investing activities. The amortization of the brand name will also be a non-cash item. Remember, when we've got intangible items, we don't do depreciation, we do amortization. So these three amounts are included in our profit, but it means they are not cash amounts. So that profit amount includes some expenses that had no cash actually being paid by the business for those expenses. They were what we call book entries. They tell us the turnover for the year was 1,150,000, and that there's a constant markup of 40% on sales. So we'll be able to work out what the gross profit is. So that, in other words, the gross profit is 40% of the sales amount. So we're only going to be looking at that information. We won't look at this information yet. We'll look at that when we do section 2 of the cash flow statements in the next lecture. So we're going to prepare the statement of cash flows. When it says direct method, that's a method that we use in FRK 121 for preparing the statement of cash flows. But we're only going to do the operating cash flow section. So here's what the final answer is going to look like. I am going to show you how we can calculate that, but we're only going to be busy with the cash flows from operating activities. As I said, you please need to memorize the wording because it's standard wording that you'll get marks for. So we first have to work out cash received from clients. Then we have to work out cash paid to suppliers and employees. With this one, there are normally two calculations because you've got to work out what you paid for purchases and for other expenses. So you have to go and look at the cash payments for other expenses as well as for purchases. So if we take cash receipts minus cash payments, it's going to give us cash generated from operations. Interest paid and received must always get shown separately. Because this is a company, remember we're changing it to a company, we're going to show taxation paid separately, and then the profit distribution paid, that's just going to be our dividend. And that's the amount given in the question, 68,000. So in this question, there are no shareholders for dividends. We're assuming that the full amount given as a dividend was actually paid as a dividend during the year. So now let's go and look at the calculations in order to get to these amounts. So we're first going to reconstruct the debtors accounts to work out the cash received from clients. So on the debit side, we're going to put the opening balance that we're going to bring down, and we get this amount from the statement of, well, from the trial balance, the financial position items that they give us at the beginning of the question. And at the end of the year, there's a balance carried down. And as I said, please make sure you're using the correct balances, because if you mix up the opening and closing, you're going to get to the wrong answer. So the closing balance owing by debtors at the end of the year is 16,000 Rand. We're going to put the total sales in for the year because we've seen it doesn't matter whether it's cash or credit sales, we can come to the same answer. So if sales were 1,150,000, we add to that the opening debtors balance, we're going to get 1,168,200. And we subtract the closing debtors balance, it means the amount of money we received in our bank account, we debit bank and credit debtors with 1,152,200. So this is going to be the first line on your statement of cash flows, the 1,152,200. That's the amount of cash we received from our clients. And you will notice that it's actually the sales amount plus the difference between the 18,200 and the 16,000. Okay, so that means clients paid us the difference between the two. 18,200 minus the 16,000 gives you 2,200. And if you took that 2,200 and added it to the 1,150,000, 1,150,000, you get to this answer as well, 1,152,200. So remember, when the debtors balance decreases, it's like customers paying us. So that's a cash receipt to 200, and the full sales amount then we just add to that to get the total receipts. Okay, so in order to calculate the cash paid to suppliers and employees, we have to do two calculations. The one is to work out how much was paid to creditors for purchases made during the year. And we're also then going to work out what are cash operating expenses that were paid during the year. But the first thing we need to do is just put in the opening balances. So for inventories, we're going to put in the opening balance, which is 18,000. And the closing balance, remember inventory is an asset, so it always has a debit balance. So we're going to carry down the balance at the end of the year on the credit side. That means we'll have an opening balance at the beginning of next year of inventories for 23,000. Creditors will always have a credit balance, So we'll have an opening balance that we brought down here of 14,000. This information is given on page 1 of the question, and we'll have a balance that we're going to carry down here of 20,000. This is the closing balance, the amount still owing to creditors at the end of the year. Okay, the amount we actually want is we want to know how much was actually paid to creditors during the year. So this is the amount we're looking for. So we need to reconstruct the inventory account so that we can find out how much the purchases were of inventory on credit during the year. So if we know this amount, we need to find out what this amount is. Okay, so we've got to work out what the bank amount is. First of all, it means we have to go back then and find out how much inventory was purchased on credit. But that we can't do until we actually know the cost of sales. Because remember, whenever we sell goods, we are going to credit the inventory account and debit cost of sales because we're transferring inventory out of the inventory account and we're going to be debiting the cost of sales account. So in the question, they've told us that the gross profit percentage is 40% on sales. So what that means is that if you sold something for 100 Rand, it means your gross profit is 40 and it means your cost is 60. Okay, so the gross profit is 40% of the sales amount. The cost is 60% of the sales amount. So to get the cost of sales, I'm going to take the sales amount, which is 1150,000, and I'm going to multiply that by 60%, and it's going to give me 690,000. Okay, so that's going to be my cost of sales. If I add that plus the closing balance of inventory, that will give me 713,000. Then if I subtract my opening balance of inventory, it means the inventory purchased on credit during the year is going to be the balancing amount of 695,000, which I'm going to be bringing down to the credit side of the creditors account. So the creditors account on the credit side will have a total amount here of 709,000. That's the opening balance plus the amounts purchased on credit. If I subtract the closing balance, it means the actual payments to creditors are 689,000 for the year. So the amount that's going to go onto my statement of cash flows for payments to suppliers is 89,000. Remember, that's the first part of the calculation that I need to do. I also need to work out what is the other expenses that I paid for that were cash amounts. So just to remind you, what happened here is the original amount for cost of sales is what will be on your statement of profit and loss, but on your statement of cash flows, we're actually recording the payments we've actually made to suppliers during the year in cash. Okay, so now there are a number of ways of working out how much the sales, how much the expenses were that we paid for cash. We already worked out in the previous slide how much we actually paid to suppliers, but now what we want to do is for other expenses, we want to work out how much of that was cash expenses. So in order to do it, we're going to reconstruct the statement of profit and loss using the information given in the question. They tell us that the net profit before tax was 115,000. Okay, we do know in the question that the sales amount was 1150,000, and we knew that 60% represented cost of sales, which was then 690,000, which meant that the gross profit for this company is 460,000. Okay, so now we can reconstruct the remaining amounts so that we can get back to what the cash amount is that we paid for other expenses. So other income, there was no interest received, but remember they did tell us there was a profit on sale of asset of 2,000 and there was a decrease in allowance for credit losses of 200. These amounts are going to be part of other income, but we'll ignore them on the cash flow statement because they are not cash amounts. We'll show the cash amount separately for the sale of the asset, and the decrease in allowance for credit losses is not a cash amount, so we ignore it when we are doing our statement of cash flows. If there was interest received, we would be showing interest received separately, but in this question there isn't any. So now if we go down and we put in expenses that we know of that are not cash flow expenses, depreciation is one, and amortization of the trade name is another. So we know that those two items are non-cash items. The other amount we know is the interest expense, and that's 1,500. So what we can do now is that if we want to, we can work out the other expenses here. If you take 460,000 and you subtract 115,000, okay, the difference then is the difference between those two, and then you're going to be taking this 2,200 out and this 1,500 out. The balancing amount here for other expenses is 345,700. So how did I get to the 345,700? You take 460,000 and I'm first going to add 2,200 and I'm going to subtract 1,500 and then I'm going to subtract my profit. And the difference will be 345,700, which are my other expenses. But I know included in other expenses are two non-cash flow items. So my only cash expense is going to be 331,700. That would include wages, telephone, anything else that we paid that had a cash element to it. So depreciation and amortization are book entries, so we don't call them, we can't put them into the statement of cash flows. So this cash expenses is the second amount that we need to calculate in order to work out cash payments to suppliers. The last thing we need to work out to do our cash flows statement operating activities section is the amount of current tax that we actually paid to SARS. So remember, this is a liability. It would have had a credit balance at the beginning of the year that told us we owed SARS 10,000. At the end of the year, we owed SARS 8,000. Okay, so we'll bring that balance down. So it's like we paid SARS 2,000 Rand because that balance has actually decreased. The tax expense for the year, which is going to go eventually to decrease our profit for the year, was 31,000. So it means we owed SARS 10,000 plus 31,000, which is 41,000. 8,000 we haven't paid. So 33,000 must then be the amount that we actually paid to SARS for the year. So that 33,000 is going to be shown as the tax payment on my statement of cash flows. Remember what I said to you, if you took the opening balance of 10,000 minus the closing balance of 8, it basically means we reduced the amount we owed SARS, so that's like a payment of 2,000, plus if you add the 31,000 to that, this is the shortcut route to calculate the actual amount of the payment that we made to SARS during the year. So now remember, we're doing this for a company, not a CC. So the statement of cash flows for the year ended, those words are important. The first part of it, we show cash flows from operating activities. We calculate that by starting with the cash received from our clients. We work that amount out when we reconstructed the debtors account. Remember, the amount we received from customers, we would have debited bank credited debtors, and that's the first amount we put here on the cash flow statement. Then the cash paid to suppliers and employees, we have to add two amounts here. The first amount is the amount we paid to creditors of 689,000. That amount would have been a credit to bank, debit to creditors, plus we had other expenses, cash expenses of 331,700. Those were cash expenses. We excluded non-cash items like amortization and depreciation. So that's a negative amount. It's in a bracket. So we reduce the cash received from clients by the cash paid to suppliers, and that gives us cash generated from operations of 131,500. So during this current year, from the actual operating their business, they received 131,500. And it's always interesting to compare that to the actual profit number, which in this question was 115,000. So this business actually did quite well because their cash generated from operations was actually slightly more than the profit they made. But that's not something you're expected to do in FRK 1-to-1. I'm just showing you that for interest's sake. Then your interest paid and tax paid you must always show separately. Also interest income if there is. Remember the tax paid, we just redid the SARS current tax payable account and worked out how much was paid to SARS. So that's the amount we would have credited bank and debited the current tax payable account. And then the last amount is actually the dividend that was paid during the year. There are no shareholders for dividend. So that's a reduction of the cash generated from operations. So if we now take the cash generated from operations and subtract these three amounts, it's going to give us cash flows from operating activities. This is an inflow of cash. If it had a bracket around it, it means that there would have been an outflow of cash. That means the amounts we paid would have been more than the amounts we've received. And that's the end of this lecture.